I studied over 1,000 ETFs and found that over 30% of them are dangerous to passive investors.
And if you're invested in some of these funds, then you could be making a huge mistake by paying more fees, taking on more risk, and having less diversification. So I'm going to show you exactly how to look out for these fraudulent ETFs so that you can be sure that you're invested in the best funds possible. Because it's not so obvious to assume that investing in some ETFs could be such a bad thing. The first ever publicly traded ETF on a stock exchange was launched in 1990, but in just over 30 years, the global markets now contain over 8,000 ETFs, which manage a total of over $10 trillion in assets. Passive investors all over the world have grown to love ETFs because of their low costs, high diversification, and minimal effort investing style. And it is this idea of minimal effort that is one of the biggest selling points of ETFs. The idea that you don't have to know anything about investing. You can just buy one of these funds, track a standard market index, and the chances are that you're going to be around 80 to 90% of active fund managers. It almost sounds too good to be true, because in some ways, it is. Whilst most ETFs do deliver on providing all of the great things that we know and love about ETFs, a significant portion of them simply try to rip us off. These harmful funds hide under the passive brand of standard ETFs, yet fail to live up to the expectations that we often set. And whilst these fraudulent ETFs can come in all shapes and sizes, I've managed to break them down into two main categories that you need to look out for. The first category is so sneaky that they actually try to pose as proper passive ETFs and basically get away with it. So let's look at 3 different funds and see if you can figure out which of these is the fraudster. We have the Invesco S&P 500 ETF, the Xtrackers Nikkei 225 ETF, and the Legal & General Battery Value Chain ETF. To some of you, it may seem obvious. To others, maybe not. But admittedly, it's not that easy just by looking at the fund names. It isn't until we start to dig further into the funds that we really start to see the differences. The Invesco and Xtrackers funds both invest in a relatively large number of stocks and have respectable costs too, at 0.05% and 0.09%. But the Legal & General fund invests in just 33 stocks and has a hefty fee of 0.49%. And whilst it's already looking bleak for the battery ETF, it's about to get a lot worse. The Invesco and Xtrackers funds both track well-renowned markets. The S&P 500, which is essentially the 500 largest stocks listed on US markets, and then the Nikkei 225, which is essentially the largest 225 stocks listed on the Japan equity markets. Both of these markets include a wide variety of market sectors, offering a good amount of diversification. The Legal & General fund, however, tracks the Selective Battery Value Chain Index. Yeah, I've not heard of that one either. Whilst this is a legitimate index, it is a very concentrated one, composing of just 30 stocks, and it is heavily dependent on the success of the battery market. So if you haven't guessed yet, the Legal & General fund is the fraudster, and it is because it is a thematic ETF. Now this phrase is a little difficult to define, but it generally refers to funds that target stocks which are positioned to benefit from potential shifts in technology, society, the environment, and demographics over time. These funds are much more specific than the classic market indices that we're so familiar with, like the S&P 500. Some other examples include the iShares Global Clean Energy ETF, the Wisdom Tree Cloud Computing ETF, and the iShares Global Timber and Forestry ETF. Yeah, there's a fund for that. The problem is with these ETFs is that the performance of all of the stocks in the fund are often all controlled by the same governing laws, technological shifts, social perception, or environmental factors. Whilst the funds are diversified because you're investing in multiple stocks, you're not actually getting that much diversification because all of the stocks are likely to perform similarly to each other. Despite these thematic funds being ETFs, they're actually more similar to investing in individual stocks. Of course, there is great upside if your bet pays off, but you're taking on a lot of risk because the fund is so concentrated, and it can be greatly impacted by so many unforeseen circumstances. Just like individual stocks, it's not uncommon for these funds to see sudden bursts of returns in short periods of time, making them look quite appealing to new investors. But these spikes can go in either direction, and the volatility of the funds mean that you could see some huge losses too. This whole risk versus reward argument reminds me of a problem that I'm facing now. I'm going on holiday soon and a bunch of my mates want to do a skydive. I mean, yeah, skydives seem pretty fun, the upside is definitely there, but the downside, let's not talk about that. We'll see how I get on. Anyway, even if you do manage to avoid these thematic ETFs, there are still plenty of funds out there that are dangerous to the average investor. And these funds are even more high profile, making them even more difficult to avoid. But don't worry, because there's no better way of routing out these ETFs than by studying an example of a fund that lost investors millions. Let's go back 2 years ago, to the summer of 2020, in the middle of a huge bull market that followed the COVID-19 flash crash in March. Big tech went on an absolute storm and started to run away from the market with gigantic returns. There was an ETF that captured this growth almost perfectly, ARKK by ARK Invest, managed by Cathie Wood. From the bottom of the market in March of 2020, ARK grew by over 350% in less than a year. Cathie Wood was labelled a genius in the headlines, and it was almost impossible to read an investing article or to watch an investing video without hearing the word ARK. The fund itself holds just 35 stocks, with a big allocation to large cap stocks in the tech and health sectors. It is a highly concentrated portfolio that is high risk, high reward, but more importantly, it is actively managed. The fund didn't track any market indices. Every stock in there was hand selected by the investment managers, which is arguably why the fund had such a successful run. But most new investors were blind to the risks that surrounded this highly concentrated portfolio. They were too busy focusing on the returns that the fund had earned over the past year. As the fund kept climbing, the number of purchased shares started to rocket, with trading volume starting out at a few million per week and increasing up to nearly 50 million per week. But then, the crash. In similar fashion to its rise, the fund lost over 75% of its value in just over a year. After the crazy ride had finished, the fund now matched the performance of the S&P 500 since inception, which sounds pretty good on paper, but the tragedy is shown more accurately by looking at the trading volumes and the flow of money in and out of the fund. These bars at the bottom of this chart show the trading volume, with green indicating a net purchase of shares and red showing a net selling of shares. As the fund started to climb, more shares were getting purchased, with the most number of shares being bought just before the peak. Shortly after the initial crash, trading volumes passed 100 million per week as investors were scrambling to sell out of the fund. But it wasn't until the fund hit rock bottom that the real damage was done. After falling over 70% already, this is when most investors started to flee from the fund, with trading volumes passing 300 million in one of the weeks. So the majority of shares were bought just before the fund reached its peak, and then most of those shares were sold just before the fund reached rock bottom, meaning that most investors would have lost a lot of money. And in fact, they wouldn't have actually seen returns anything like the average S&P 500 investor over that same time period. This just shows that we need a rational investing process when selecting ETFs, so that we don't get blinded by the sometimes impressive returns that some active ETFs can show over certain periods. It is only made worse by the high fees that most active funds come with ARK having an ongoing charge of 0.75%. Making it 15 times more expensive than the Invesco S&P 500 ETF. We only have to look at the SPIVA report, which measures actively managed funds against their relative benchmark, to see how the majority of actively managed US large cap funds fail to beat the S&P 500. This pattern is consistently true in countries all around the world. So it turns out that some of these more exciting ETFs with cooler names and much more marketing behind them are often some of the most harmful ETFs that are out there. But there is one more thing that you need to understand about these funds before you disregard them completely. Whilst they can be harmful to investors who lean on them too heavily, that doesn't necessarily mean that they shouldn't exist at all, and that you absolutely should not invest in them. They can be used as an effective way to add small biases to your portfolio, allowing you to create a set allocation towards a certain market sector that you believe will perform well. In fact, it is often less risky to add some of these ETFs, as opposed to investing in individual stocks, because they actually offer more diversification than what an individual stock can. Just make sure that you're mindful of the fees. That said, if you allocate too much of your portfolio to these highly concentrated funds, then you need to understand that you're taking on a lot of risk, and you should plan for that accordingly. As a general rule of thumb, we are often better off going for the more boring option, the standard passive ETFs with low cost and maximum diversification, which in many ways seems counterintuitive. But it's important to remember that complexity doesn't count for anything in investing. If you keep your costs low, diversify, and manage risk properly, you'll be on a good path. With that in mind, I got to make a call. Hey up, mate. You know what you said about a skydive? Yeah, nah, I think I'm gonna have to pass. Too risky.
3 days later.
Do as I say, not as I do. Jokes aside, avoiding the most dangerous ETFs doesn't really count for anything on its own. There's actually one more concept that you have to combine with it, and without this, you're not going to be able to build the perfect portfolio. That's why you really should watch this video here, because it's going to show you how to find the best ETFs to help you build the best portfolio for you.